Imagine this is your money in a jar. You keep filling it up every day with new money, hoping it will one day multiply. But suddenly a hole appears in your jar and begins to empty your savings. And as time passes, the hole gets bigger until your jar is almost empty. That hole is inflation, and right now it is widening faster than any saving rulebook admits. If you think compound interest alone will plug it, you are completely wrong, because the math says otherwise, and the math does not care about optimism. Today we'll see why this hole in your jar is expanding so fast, and if you stay until the end, I'll tell you how to fix this hole so it doesn't expand anymore. Let's start. I bet you have heard that money multiplies when you give it time. Put a few dollars aside, wait decades, retire smiling. That story worked when prices crawled. Today, prices are sprinting. When the price of bread runs 6% and your savings grow 5%, your real loaf count shrinks every single year, even while the account balance looks larger. That cruel gap is why compounding fails against inflation. Unless you make one radical change that I will reveal later. Feel the gap through Veronica. She is 30, disciplined, and sets $200 aside each month into a fund that promises 5%. 20 years later, a proud statement flashes $81,000. But prices in those years doubled. The real value of her $81,000 is barely $40,000 in today's terms. 2 decades of sacrifice bought half the power she expected. She did nothing wrong. She simply trusted a rule that no longer fits today's climate. But why is the climate so harsh? Because money supply exploded while goods stayed scarce. Central banks printed waves of currency to cushion crises. Governments borrowed freely. Supply chains snapped. Energy costs spiked. Wages chased prices, which chased wages again. In only 5 years, the dollar area added more than 40% new currency units. More dollars chasing the same goods equals higher tags on everything from rent to coffee. That is not temporary steam, it is structural heat baked in by policy and debt. You can just look around to notice it. A compact car that cost $25,000 in 2020 now lists at $33,000. Average rent that once took 1/3 of income now takes almost 1/2. Groceries feel heavier even when the bag is lighter. Or rather, it doesn't feel, it just is. Each rise slices away the future spending power of static savings. Compounding at 5 while living, costs grow, 6 resembles running up the down escalator. You sweat but stay lower. Maybe you aim for higher returns. Index funds have averaged 7 or 8% long term, you argue. Test that hope. A single year of 10% inflation wipes out an entire year of 8% market growth and drags the real average back towards 0. The true formula is simple. Real growth equals nominal growth minus inflation. If inflation wins more often than it loses, you lose, no matter how long you hold the line. And to go higher, and without sweating, you can simply join our free Telegram community with the link in the description, where we will show you how to start the only business that wins against inflation at 0 price. But I'll tell you more about it later. These numbers squeeze even high earners. Surgeons who park cash in safe 3% bonds surrender 3 real percent every year when inflation sits at 6. That is $1,500 of lost power on every 50,000. Gone as quietly as a subscription you forgot to cancel. The wealthy hate hidden leakage, so they pivot early. Small investors rarely notice until it is too late. At this point, you may feel the knot in your stomach. Good, that tension is truth knocking. Traditional compounding was designed for a slow price world that no longer exists. Waiting longer or adding modest drips will not close the wound. You need a different lever, one that turns inflation from enemy to servant. Keep listening, because the lever arrives soon. First, see why normal tweaks fail. Daniel, 26, tucks $150 into an index fund each month, expecting 7%. After 10 years, he sees $24,000 nominal. Meanwhile, prices climb 20%. His real gain is less impressive than a year of average salary. He followed every guru tip: start early, buy broad, stay calm. Yet inflation stole the miracle. Even lump sums disappoint now. A business owner drops $50,000 into bonds paying 4%. With living costs rising 7%, she loses $3,500 of buying power each year. That steady coupon feels safe, yet silently erodes. The spreadsheet shows growth. The grocery aisle shows decay. The message is simple and brutal. If the cash flows from your assets do not rise with prices, your compounding engine is stalled. It whirs, it clicks, but the wheels spin on ice. So what is the missing gear? Here it is, whispered so inflation cannot hear. You must own assets whose cash flows float upward with or faster than inflation. And you must pour those rising flows back into more floating cash flows. That move turns compounding dynamic. It puts the escalator under your feet instead of your shoulders. Consider real estate with adjustable rents. Buy a modest apartment today for $100,000. Net rent 5%. If rents track general prices at 6%, next year the rent is $5,300, then $5,600, and so on. Your yield on original cost climbs above 6% without extra effort. Reinvest just the annual raise and you buy a second unit years earlier than a flat plan predicted. Each new unit adds its own rising rent. The loop feeds itself faster than inflation can chew. Public companies with pricing power work the same way. A firm selling essential software may hike fees 8% annually. Dividends follow profit. When you reinvest those bigger dividends into more shares or into other inflation-resistant assets, the snowball grows in real terms. Royalty streams tied to sales, energy partnerships pegged to fuel prices, farmland indexed to crop income, even your own services charged at market rates, all of them breathe with inflation, rather than suffocate under it. Skills are the most flexible asset of all. A graphic designer who masters 3D animation can double hourly rates within a year. If rates then rise line with costs, the designer stays ahead while funding further investments. Turning personal income into an inflation-linked river is often faster than finding the perfect index fund. Protection still matters. Fees, taxes, and catastrophic loss can drag your real returns back below zero. Use tax shelters where legal. Carry insurance on tangible property. Diversify across sectors and regions. Inflation steals enough already. Do not add holes of your own making. Let us run a quiet scenario that ties it together. Mia buys 2 vending machines that each clear $100 monthly. Snack costs rise with inflation, but so does retail price per snack, so her margin floats, not fixed. She funnels every extra dollar into more machines. After 5 years, she owns 10 units, producing $1,200 a month in today's money. Prices doubled, but her net cash flow tripled because each machine brought friends. That is dynamic compounding. Inflation tried to bite, Mia fed it steel. You do not need big capital to start. Pick one small asset or one profitable skill this week that scales with prices. List ideas tonight. A micro rental, a royalty-bearing ebook, a niche subscription service, a piece of farmland through a cooperative, shares of a company that prints price tags, not coupons. Choose one. Act, watch the first cash flow increase, then reinvest ruthlessly. Momentum will feel slow then sudden, exactly how compound interest was supposed to feel before inflation hijacked the stage. Remember the line that exposes complacency. Nominal growth is vanity. Real growth is sanity. News anchors will cheer record stock indexes while a loaf of bread doubles. Do not let that blindfold stay on. Measure everything in units of basic living. Ask monthly, does my net worth buy more life or less? If less, pivot now. Time for the reveal. The only way compounding defeats inflation is by owning and compounding cash flows that crawl upward with prices, then recycling those cash flows into more of the same. That is the lever. Fixed coupons and flat salaries are cemeteries. Floating income is a launch pad. Once you grip this lever, inflation flips sides. Each price hike sends a raise your way. Each raise buys new engines that issue more raises. The loop outpaces the spiral. And the only business that can make you that extra money to beat inflation is making videos without showing your face on YouTube. like the one you're watching. I've started a completely free community on Telegram where I'll explain how to start from scratch. And to prove it works, you can simply watch this channel, which is the clearest proof. So breathe, but do not relax. Inflation never sleeps, so neither can your strategy. Spend this week hunting, choosing, planting. Tell me in the comments which asset or skill you will lock in first. Subscribe for follow-up guides, and every time you see a price tag creep up, smile a little, because you will know that your own cash flows just crept higher too, and the compounding hole has finally become a ladder. Explode the like button, and see you soon in the Telegram community. I'll wait for you.